Welcome all. Thank you for tuning in to Money Concepts, Straightest Path to Success series. I'm Anthony Rovai. I'm here with my associate George Haas. And today we're going to be talking a little bit about lazy money. And what we mean by lazy money is people that have their money sitting in basically savings, checking accounts, and CDs. George, why don't you pull up the sheet? I went on this morning to the web and looked at our local banks' CD rates, and we're going to kind of see, how lazy that money really is. If I got my money in the bank, tell me what they're going to pay me for 3 years.
All right, for a 3-year CD, they will pay you 0.45% interest annually.
Well, what's that for a year?
That comes up
$10,000.
for $10,000. That's $45 a year that you'll make in interest on.
Well, let's look here. So I'm looking here at one of our insurance companies that has a multi-year guarantee product, and their 3-year is 1.9%. So that would be $190 a year. That's quite a bit more savings.
4 times as much as you'll make in the bank.
Let's take a look at the 5-year.
The 5-year is 0.65%, which on $10,000 is $65 a year.
Wow, they're really doing it. Let's see here. 5 years, 2.5%. That's $250 a year. That's quite a bit more money that would be, going to you. So let's compare the two.
What's the safety of principal on them?
They both have a safety of principal. Granted, the bank is being backed by the bank, and they're going to have the government's FDIC insurance on it, where the insurance company is going to be safe, but they aren't going to have the FDIC insurance. It's just going to be backed by the claims paying ability of that insurance company. Our insurance companies that we have that we work with and put our clients' money with are all in the A rating area,
Right.
A, maybe an A minus or something like that.
Right. Although if you compare the reserve requirements for the banking system compared to the insurance,
insurance is actually regulated much more strictly on the amount of reserves they need to keep on hand. They need to pretty much be almost completely solvent and to be able to pay all the claims that they might have coming in. So whereas a bank usually have a 10% reserve requirement, so they're taking and lending out your money you put in their CD and 10 times over.
Right. They're leveraging your money and making
prevailing, if they set it on mortgages, they're charging close to 4% plus or minus, on a mortgage. So that's a huge arbitrage,
Right, exactly. How does liquidity compare? How does the liquidity, and maybe we need to explain to people what liquidity is and how important it is.
Well, yeah, I think that's a very important question. When you're talking about investing in a CD or a multi-year guaranteed product, you're basically saying, I'm going to lock my money up for X amount of years, say 3 years or 5 years. CDs usually will have an early withdrawal penalty. It's really not too horrific. A lot of times they'll just give you back your principal, maybe a small penalty. But yet, on the other hand, they're not giving you much in the way of a return. I have one of the companies working here, and I'm looking at their penalty. I mean, if you're not going to put it in there for the 3 years, then you shouldn't be using such a product because they slap your hand hard. I'm looking here, they've got a 3-year product, a 5-year product, a 7-year product, and a 10-year guaranteed term for these. And the penalty all starts at 7%, and then goes down 1% per year. So clearly, they do not want you to pull the money out.
Right.
But the nice thing is this also, but it does have, after the, starting in basically month 13, you can withdraw 10% from this without any penalties, which I think is a really nice feature. That's not in a CD. So, let's just say the client's got $100,000 and they're going to they don't think they're gonna need it in the next 3 years. Well, if they end up needing it in year 2, or a portion of it, they can, at 10% from 100,000, that's a $10,000 they get access to without incurring any penalties. So that's pretty generous.
Yeah,
Pretty
it
generous,
really
so.
is. How does age come into play when you're talking about those?
When you're using a multi-year guaranteed insurance product, what you got to understand is these products are looked a lot like, treated a lot like an IRA. It's not an IRA, but so if you're under 59 and a half, then you could be subject to that IRA 10% penalty if you pull it out. So that's the, so if, anybody, let's just say 60 and older, these are fantastic for them because there is no penalty.
Right.
If you're younger than that, you're going to want to use an IRA or something like that, so you aren't going to get hit with a 10% penalty when you pull the money out.
Right, so
But,
you get the tax deferral that you would get in your IRA.
yes. Yeah, well, they're both, and that's the beauty of it. I mean, you don't have to have it in an IRA to get the tax deferral. So,
Right.
so the multi-year guarantee product does not generate a 1099. You control when you pay taxes. When you take out the money, basically the interest of it, you'll be paying taxes at that point in time. Whereas CD, if you were actually earning something, you're going to get a 1099 every year, so you have less money to earn into the next year. You have to pay taxes on it. Like we said, I mean, the surrender penalty, that's a big downside.
Right.
And that's, everybody needs to be aware of it. It's not FDIC insured, you need to be aware of that. But if you're working with a highly rated insurance company, they're probably better capitalized than the bank is anyways.
Right, exactly. And that brings up the point about FDIC insurance. Like, what does it actually cover?
Yeah, that's an interesting thing. There's a big misnomer about FDIC, and FDIC is there in case of fraud. It's not in there, if there's no fraud that caused the issue, it's really not, there's no, quote, insurance.
Right, right.
The Federal Reserve may take over the bank, but it doesn't mean they take over the bank and tomorrow you walk in and get your deposit.
Exactly.
I mean, you need to get in line, they're going to take over the bank, even if there was, quote, something going on, they're going to take over the bank, and then they'll look at why is it insolvent, and then they're going to work through the steps to get money flowing to be able to get the money back to the consumers. It's
Right.
not an automatic. It's
Yeah.
not like FDIC comes in and waves a wand, and the next thing you know, it's like, oh, here's all my money.
Right.
No.
They might get it back months later.
Months
at
and
a
months, yes.
percentage of what they had invested.
Well, they do have limits. Remember,
Right.
most of the times it's 100,000
Right.
per name on the account, per name. In other words, so. But that brings up an interesting thing is that we do have, through our brokerage, we do have the FDI insured accounts or investments
Right,
that we
right.
have in there. And, we have that one that actually is over $1 million of FDIC insurance.
Right. They put it in 10 different accounts. Each is
Yeah,
covered.
so it's basically, it's like you have one thing, but it's actually spread over 10 different institutions are basically paying you the interest.
Right, right.
But it's not, a
Wow.
lot better than, going to 5 different banks and opening up one in your name, one in your wife's name, one in your joint name. I mean, that's a lot of work.
Right, yeah.
know.
You'll save a lot in gas money by
Yeah.
going to the brokerage.
Exactly.
All securities through Money Concepts Capital Corporation.
Member of FINRA and SIPC.